Hey guys, thank you for stopping by. Don't forget to subscribe, like, and share. And I hope you enjoyed this interview. The Central Bank of Nigeria announced in March this year new capital requirements for banks. The guidelines require that international banks must raise their capital base to 500 billion naira, national banks to 200 billion, and regional banks to 50 billion naira. In response to the mandate of the CBN, the Securities and Exchange Commission, that's SEC, released its guidelines, comprehensive framework. Of course, the SEC is the press regulator. It released comprehensive framework providing detailed guidelines for banks, holding companies, as well as market participants on filing applications for capital raises and mergers and acquisitions. Now, since this announcement, we've seen some top Nigerian banks eyeing the international and local capital markets to raise fresh capital in a bid to meet the recapitalization exercise within the 2-year window till March of 2026. The CBN proposed various ways for banks to raise capital, including issuing new shares, mergers and acquisitions, or even adjusting their license categories. Presently, the NGX stock market segment is experiencing a surge in activity as listed commercial banks provide investors with a chance to own a portion of the pie and for some to raise their stake. How will this impact Nigeria's capital market? Is the capital market deep enough for these capital raisings? Is the Nigerian economy healthy enough now to finance about $5 billion in new capital for banks? My guest joins me now to discuss this topic. He's Mr. Tajuddin Olayinka. He is the Chief Executive Officer at Wyoming Capital and Partners. Good morning, Mr. Olayinka, and thank you for joining us.
Good morning, Nancy. It's my pleasure.
Okay, let's get started. The banking sector is a bit excited now. Okay. The banking sector is a bit excited now and abuzz with a rush for capital. Is the stock market as excited and, glad with this, with this development? What's the level of excitement for the capital market?
Okay. The excitement will always be there, but are they totally excited? Maybe that is the word I should use. Are they totally excited? Because economy is going through a challenging time, and for that reason, it is possible that some investors will not be able to actually participate, because of low purchasing power and all those stuff. And those investors already know themselves that yes, this thing is coming. Even when they are doing right, will I be able to take my rights? What options are available to me that I can still participate? All sort of questions are being asked. But of course, there are traditional investors, and I'm sure the banks are actually targeting these traditional investors. Quite unlike what we had in 2004, 2005, when this bank came up with this capitalization exercise. This time around, we have more asset management companies operating in the capital market space. Actually, creating more active activities in the market. So, for that reason, I've said that yes, maybe the retail investors may be quite challenged this time. But insurance investors, such as asset management company, the PFAs, all those category of investors and high net worth individuals will still be able to either take their right or take or participate in new offer for subscription. So yes, excitement is there, but are they totally excited? That's the question we should be looking at. We should try to answer. Not many of them will be able to exercise their right, and for that reason, we want to see what windows are open to those of them who may not either be able to participate in the public offering, or who may not be able to also take their rights. But again, if you look at what is going on now, the approach this time around, because of the digital status of the market itself, the offering itself, we are likely to see some, we're like to see participation from young generation of Nigerians, young generation of investors. Those who were not part of it in the past may also be part of it now. Just a little shift from what we saw in the past, where even the shoemaker was able to participate because the economy was economy had a boom, and there was some kind of credit to the market, to investors. So some of them were able to participate then. But this time around, there's no credit. But of course, because of the digitalization of the offering process, we may see new generation of investors who are actually tech savvy and who want to benefit from this market. I can tell you clearly, only institutional investors should be able to do so much this time around. And of course, we are expecting foreign portfolio investors to also participate. That's on one part. That's on one part. But of course, if you also look at the interest rate, the yield environment in the fixed income space, it's also a challenge on the pricing of this equity. The share that be offered to the market by some of these banks. But of course, we have seen some kind of resilience in the equity market. But ordinarily, with that kind of high yield environment, we expect that equity prices should have gone down below the level. In fact, index should have gone down below the level we have it. But because of the presence of this category of investors that I mentioned earlier, the asset management companies, high net worth individuals are more, PFAs also playing in that space. We seem to be having, a more resilient market. So for that reason, I think we will still have some reasonable level of participation.
Okay, you said a lot, Mr. Lankan. Let me try to unpack that. When you talked about the level of excitement earlier, are you saying that the level of excitement we saw perhaps in 2005 during the banking consolidation, was it more than we're seeing now? Let's get that sorted first. Okay.
It was more then than what we are seeing now, because then, investors had access to credit. Investors were able to, in fact, economy was more robust than what we have now. So, there were several windows open even to new investors who are not part of it before. That time I remember going on Broad Street in my red jacket, and a shoemaker called me. He said that you understand that there was this public offer in the market. I should come and advise him. That's what a shoemaker. But I don't think a shoemaker will come near this market at this time with the kind of low purchasing power. So what I'm saying now that what has changed now that we may have young generation of investors, all those young guys, young bankers, people who didn't participate then because of the fact that we use more. We didn't use digital methods. But now that we are now using technology. I'd like to see new generation of investors coming in this time around.
Okay, but earlier on you also did mention that institutional investors as well as foreign investors will be the one that perhaps will gain from this recapitalization exercise or this capital raising from the market. Where does it leave retail investors? Because there was a time, I think in 2022, there was a time that foreign investors dominated the market. After some time, retail investors usurped that position, and it went back again to foreign investors. Can you give me a sense of the composition of our markets now? Then I can ask the second question I wanted to ask, because it will lead to that.
Nancy, the investor that we have, the reason we have resilient in the market so far is just because we have more institutional investors playing the market, local investors who are institutional, not retail. Okay. Retail are not doing much. Retail are not doing much. Okay. But of course, some of them will still be able to do something. Don't forget, we have low purchasing power. In fact, the economy itself has a low purchasing power. So that's the reason.
Okay, so this means now that this capital raising that the banks are doing right now, the foreign investors as well as institutional investors have more to gain than the retail investors.
Exactly.
Okay. The aspect of technology that you brought in, bringing in the new generation investors, young people now, because even on their phones, they can buy shares and all of that. Will that component be also a contributor? Would we see, because of the market is awash with offerings now, be it rights issue, public offer, or even private placement, with technology now contributes to having more retail investors and new investors?
Yeah, technology, that's what I said, technology will now be able to replace the traditional retail investor that we will not be having this time around. The technology will bring in this young generation of investors to participate, and that for that reason, we still have maybe I'll call them a new bride. These young generation of investors who are tech savvy, who like to see anything on technology, and of course for that reason they could be attracted, and so we will still have them participate in that space. And so those will represent what we call retail investors, but not the traditional ones we used to see, not those shoemakers, not those mechanics who want to participate in public offering. This time around, we are likely to see more sophisticated, younger generation, retail investors.
What will it take to bring those categories of people into the market? Like you mentioned that during the consolidation days with your red jacket, a shoemaker approached you. What will it take to bring in those kind of people? Is it about low purchasing power now, or even those categories of people do not have the information? Unlike those days, it was really, information was everywhere. Everybody wanted to invest in stock market. They were giving margin loans and all of that. That is not existent anymore now. But what will it take to bring in this category of people? Is it just about low purchasing power, or the information is not really there to those categories of people? They don't understand it.
I believe they will also understand it. What is happening is that, in fact, the information dissemination at this time is even broader compared to what we had in the past. Of course, I mean, there will be a lot of advertisements, jingles, and all those things on TV and radio, and so that will also, attract them. But what I'm saying is that, do they have can they make savings at this time when they are unable to feed? Can they make reasonable savings when they are not able to pay their students' school fees? Can they make reasonable savings when what they hear is just to take care of them, just for one day? So, but I know that there are still some this category of investors who will still struggle. They will struggle to be part of it, but not many of them be part of it, and that's why I think. Some of these banks are also trying to do right issues, so that even if you cannot participate directly, you cannot participate in the new offering. Take your right. If you can't take your right, which is coming at a discount, if you can't take your right, you can also sell that right. Sell part of it, and use the proceeds to take part. You can do half. You can do part of it by selling part of the right to take care of the remaining rights. So we'll see what the judgment is advice from brokers and those discipline agents who will be marketing this offer.
Let's dwell a little bit more on how inflation is impacting the sale of perhaps these rights issues and public offer. You've talked about it a bit in terms of purchasing power. How much of an impact with this high inflationary environment in Nigeria contributes to this recent banks capital raisings that we're seeing left, right, and center?
Of course, we have seen that reflect in interest rates. Because of the fact that we have high inflation, interest rate is up. Ideally, this is not the time for anybody to come to the market to raise money when interest rate is high. What that means that you are going to raise money at a higher cost of capital. And no board of a company, no board of a bank will want to approve that. They want to raise money at a lower cost of capital, lower cost of equity. But cost of debt is high. So once cost of debt is high, there is no way you can push down the cost of equity. But because market is resilient, we still have a bit of accommodation for them. For instance, a stock that is, let's look at Fidelity is doing one now. Let's assume that if market is right for them, maybe ideally they should be doing it at maybe 15 naira per share. But now they are doing it at 9 naira or 10 naira. So when you look at that, that is the impact of inflation on what they are doing, because of the fact that the cost of debt is high. We are in a high interest rate environment, and for that reason, it is not likely that they can issue equity at a more higher price. So what they are doing is that most of them are issuing equity at a lower PE ratio, and so this is not something that is good for the market. But because they don't have any choice. More so also that they are restricted to the kind of capital they can raise. For instance, it can only be by way of share capital. That qualification can only be share capital and share premium, which means that they have to raise so many shares to be able to meet that requirement. Unlike when they had the opportunity to improve their reserve. But now this time around, they are issuing more shares. So it's going to create a lot of dilution, earnings dilution, for shareholders. So they have to demonstrate that, yes, it's true that they are likely to be any dilution. But this new capitalism will bring something new to the table for existing investors and for those who come in newly to be part of the market, so that any dilution will be subdued. So these are things that these banks we need to demonstrate, and for that reason, maybe we will see more participation once they can demonstrate that, because no shareholder wants to suffer any dilution. And so, if you are issuing too many shares, and those, which means that before now you used to do any per share of 3 naira, and after issuing this one, you're not going to be doing 2 naira 50 kobo. That's not good enough. So you have to demonstrate that you can go beyond, you can go above that 3 naira per share, maybe to 4 naira. So if you can demonstrate that, of course, irrespective of what is going on in the fixed income space or what is going on in the economy, you still see some investors who participate and say that there is future for this company. You must demonstrate that you have a very strong earning power.
This rush at this time, is the market also concerned about the timing in terms of, there's a 2-year window from when the central bank announced this in March till March of 2026, so 2-year window. How concerned is the market with the rush at this time? How calculated is the risk? Because I'm also taking a look at it that banks are rushing it to the market at this time. Will the market be a bit fatigued? Why don't we see a kind of sequencing? Because every bank is coming in at the same time. We are hoping that the economy gets better, because the economy is not doing well enough. The economy is not healthy now to perhaps give you that kind of capital. You will sweat blood, sweat, and tears to get that kind of capital. So will the market be a bit fatigued? Why not for banks to perhaps wait a while? Is that in any way kind of calculation, or I'm just thinking on my own? I don't know, but I'm thinking so.
I think the banks themselves must have considered the fact that delay could be dangerous. If you do not want to go through consolidation, don't want to go through mandates of consolidation, or you don't want to be acquired, or you don't want to downgrade your license status. So you need to act fast and see what the market has in stock for you. I believe before now, most of them will have had some series of meetings with professional parties, to see what the market has in stock for them. But I think for those of them that are international, who need to raise as much as 500 billion, or who need to push their market, their capital, capital qualification to 500 billion, they need to really act fast. Actually, I thought before now CBN was going to be a bit liberal, to some extent. Before you see that before CBN came up with this new capital requirement, they made sure that all the banks have submitted their accounts to CBN for full year 2023. So banks that were probably in fact, they knew the status of all those banks. They knew that yes, this is their status. This is what they represent, and that's why they said, okay, we won't consider your capital reserve or your any form of reserve to be part of this new capital requirement. So CBN understand that if CBN had given them that latitude to use their dividend they paid for 2023 account to be part of this capitalism, it would have been good for some of the banks. I thought they were going to do that for them, so that for instance, all those big banks will have used the dividend they paid this year, which was for 2023 account, to satisfy the right for those existing shareholders. In fact, in that case, all existing shareholders will be able to take their right, because it will be done through a trust arrangement. I thought that was going to happen, but CBN beat all the banks to that. And so, what some of the banks are now saying is just to educate some of these investors. Okay, we just paid you, dividend, full year dividend. We just paid you dividend for this for 2023. You can use this dividend to buy your right, or to even be part of the subscription, and you can add it to augment what you have elsewhere, so that you'll be able to be part of this. But the greater thing that will make this offer, all these offers successful, is for the banks to come to the open to say, yes, this new capital, even though we are using more shares, than we should ideally do. We are these new shares, this new capital that we are raising will bring new things to the table. Not that it's going to create a very serious earnings dilution. Once that message can be passed to the outside world, to all potential investors, of course, we'll see participation from all categories of investors. What investors like to see is this new capital bringing something to the table? Or is it just want to buy technology, you want to invest in this, want to invest in that? What is that thing bringing to the table? Is it going to create any dilution? If it's not going to create any dilution, you will see support. So that's why I look at it.
Now, if this move, according to the CBN, is to fortify the banking sector, won't the market be also facing a risk of lopsidedness? I hope you understand what I mean, because this would help fortify the banking sector. The banking sector is a major component of the stock market as it is. The stock market is already heavy weighted on the banks. So will this additional strength, wouldn't it cause more lopsidedness for the stock market?
Well, of course, it should. It should, but what will improve that will be when, because we don't forget also that we have more companies also waiting to test the market.
Exactly.
Except that this bank coming now may also disturb them. But if we have a successful outing between now and say end of the year, we would like to see more companies come to the market to raise money, and those who are already in the market also raising new money, to be able to improve their capacity to deploy resources. So what will reduce that excess weight from the banking sector is for more companies to be listed on the exchange, and I think the exchange itself is driving towards that. I believe we will have that improvement once we have improvement in the economy. The economy is what is driving most of them away at this time. But of course, they will have no choice than to also come to the market. Why government continues to struggle on how best to position the economy. I believe we will overcome all these challenges.
Can the banks raise all the capital from the stock market? All the banks that have announced, from Wema, Fidelity, Access Holdings, FCMB, GTCO, UBA, Zenith, can the banks raise all the capital they need for the recap from the stock market?
Let's look at it this way.
It's a yes or no question, Mr. Lainka. I don't want to look at it anyway.
It's because there are three critical ways that they can raise this money, apart from issuing new shares, either by way of right or by way of oversubscription, also by way of placing. I don't want to call it private placement. Some have called it private placement. It's actually placing. No public company can do private placement. What they can do is placing, to place that share before a particular investor, maybe one or two investors who can bring something on board to improve the luck of that bank. So they can do placing. So I expect some of these banks to follow that route of placing as against doing public offer or doing right issue. They may do combination of right, public offer, and placing.
So does that answer the question of if the banks can raise all the capital from the stock market?
Yes, it answers, because they may need to take in new investors that are not part of the market already. That's why I said they may do placing.
Placing, yes.
They can do placing. So placing will now bring in these sophisticated investors, somebody who want to who want to have a controlling interest in the bank, or who want to have at least 21% ownership of the bank. And it's not part of the system already. They can bring such people in, and that will also be new category of investors in the market. There are a lot of them that they do through placing, and of course, if they cannot meet it through that agreement, they can also maybe as they approach the final lap of the exercise, they can actually go through merger or consolidation.
Will the banks, do you think if the banks will meet the recapitalization process? Do you think that the banks can meet the recapitalization deadline with their processes so far of seeking more funds from the market?
They will meet it. I've given you the different route they can take. If they are going to, if you can do it, whether through placing or merger. In fact, the last thing there is for you to go for merger. And once you can do merger and so successful merger, you are there. What you know that one of you or two of you will lose to identity and you create a new identity, just like you have in Sterling Bank.
Are there risks associated with the rush for capital at the same time? Everybody coming, yes.
There's always risk.
Yeah, because we're always talking of the good side. How about the bad side of it?
There's always risk that you may not be able to get as much as you want. That's why I said, even if you don't get as much as you want now, you still have opportunity to come back later, especially if you are going to pay dividend in 2024, your 2024 account. If you do so much that you have improved a lot of your bank in terms of earnings, and then you can use those dividends to also, and in that way, what you just need to do is to come up with what I would call not a right issue, more like a mandatory right issue, whereby all shareholders will exercise their right through instead of paying dividend cash, they use that dividend to exercise that right for them, and they can do that one through a trustee. So it's going to be, I believe, by 2024 December, most of them will know whether they can actually pay dividend that is reasonable, that will make them to actually meet that requirement.
Can you enumerate some banks that have offers now, perhaps for the audience, those that are interested? What are the offers on ground now? I know Fidelity just brought out it. Wema Bank, I think, started this. I think Wema Bank, is it 40 billion in some kind of transaction, if I'm not mistaken? So can you just run through some offers that are on ground, and what are the opportunities for new investors?
I know Fidelity is, in fact, both Fidelity and Wema, they are offering. It's not right to say that they actually rushed to the market. They were doing something like this. They were preparing for capital raising, not to this size. They were preparing for capital raising before now. So they wanted to short their capital for one reason or the other. And so they were already preparing for that before CBN came up with this new guidelines. So some of them were ahead of the guidelines. And so when the guidelines came, what they just needed to do is to increase the size and change the momentum. So that's what is happening in the case of Fidelity. I think Fidelity and Wema, but these are public companies. It is also possible that some of these banks that have holding companies, for instance, a bank is having holding company structure. The bank itself is not public; it's a private company. If the holding company believe that they can source money outside without coming to the market, some of them may be doing it through the bank directly, as against the holding company coming to the market, because only the holding company can come to raise that money for them, being a public company, except they want to also make the bank itself to also be a public company. So for that reason, there might be some capital raising, like private placement, going underneath that are not part of that are not known to the public. For now, if they are done through private placement, it's different from placing. No public company can do private placement. What they can do is placing. But the banks that are subsidiary of this holding company that are still private company, social bank limited, they can also within that confine be able to do private placement and raise money, while the holding company can come later and raise money through the public. So that may be going on that way. A lot of strategy, will be going on, in the banking circle to see how best they can achieve this requirement. But I believe the two we still have, to the best of my knowledge, are these two public institutions.
Okay, so you've talked about Wema and Fidelity.
Yes.
Which other banks have offers? Are you selling, which ones are you marketing to your?
Well, we are marketing, like I said, unless they are public companies, top brokers will market them. But like I said, there could be some that are doing it through private placement, maybe through their subsidiaries, not through the public, not through the one that is not to the public. And so until they come to the market, we will not know whether. But I know that a lot of meetings are going on now. Professional parties, having meetings with all these banks. A lot of them, no one, none of them. In fact, some of them are even those some of them that are private, also thinking of coming to the market, to raise money. So there's a lot of meetings going on with professional parties, and at this time, it's people coming to say these are just the category of banks that we'll see in the next few days. But I can tell that a lot of meetings are going on at the moment.
Let's talk as we end the show. Let's talk about the chairman of FBN Holdings. FBN, that's Femi Otedola, acquiring additional 4.63% stake in the company, taking his stake to about 11.64%. A memo was written that a communication was given to the exchange on this. How is the market taking this news?
Well, market is used to that
And we saw that
kind
the
of.
FBN, sorry to cut you short, the share price yesterday sold off. It ended in a bearish position.
But it is also because he's doing it to negotiate. He doesn't want the share price to move so that it does not affect what they plan to do in future. And of course, he doesn't want to disrupt the market. He doesn't want a situation where it will put pressure on the share price. So there must be a particular investor who was willing to actually offer his own to him, and that was why he could get it, to that arrangement. But Otedola is looking beyond just increasing his share. He knows that they might be doing right, and for him to be able to benefit more from right, he needs to increase his shareholding in the company to be able to benefit from that they'll be doing in the next few weeks or the next few months. So I think it's time to be ahead of what the market or what the bank will do. That's what I suspect is happening here.
Okay. And I think the holdco is set to, get about 300 billion naira in fresh capital. So let's see how that pans out. Thank you very much, Mr. Laika, for joining me this morning. I wish you a lovely day.
Thank you very much. I appreciate it. It's my pleasure.
All right, I've been speaking with Mr. Tajuddin Olayinka, who is the Chief Executive Officer at Wyoming Capital and Partners. We've been talking about fundraising, that's capital raisings by banks from the stock market. So if you're a savvy investor, you need to, take in this opportunity. I'll see you all again tomorrow, God willing. I am Nancy Naji. Be the best you can be and be the change that you want to see. Thank you for watching. In case this is your first time watching us, thank you. Don't forget to subscribe to our YouTube channel, drop your comments as well as like, and most of all, share our content.